If you've been investing in crypto and you're wondering why you keep missing high returning opportunities, this video is for you. My name is Frank Hepworth. My 2021 investing thesis multiplied my portfolio 11x. As a former regulatory attorney, I helped launch crypto ETFs, and I wrote the crypto investing policies for exchanges and regulators. And these days, I'm running Yield School, which is a non-custodial crypto native consultancy that consults over 1,500 high net worth investors. To get the high returning opportunities, different analytical frameworks are required that most Wall Street investors do not even know exists. May 11, 2021, JP Morgan analysts say Ethereum is overpriced. 6 months later, its price increases 100%. April 2024, Goldman Sachs denies crypto as an attractive asset class. And then over the next 18 months, Bitcoin's market cap increases by 1.3 trillion. December 2017, Morgan Stanley analysts tell clients the true price of Bitcoin might be zero. 4 years later, they're launching crypto funds for their clients. These companies are the pinnacle of Wall Street. So why do their analysts keep misreading the market? That's what we'll cover now, to make sure these same blind spots don't cost you millions. Here is the experience of the average crypto investor. In 2024, Bitcoin surged 136%, but the average investor made just $5,482. Bitcoin more than doubled in 2023, but the average investor made only $887. The problem isn't that crypto lacks proper investing methods and is just a crapshoot. The problem is that crypto has a different infrastructure that traditional analysts simply don't know how to navigate. When a Goldman Sachs analyst evaluates a stock like Apple or a company like Apple, they just open a Bloomberg terminal. On there, every piece of data is standardized, audited, and delivered in a very consistent format. Price to earning ratios, debt to equity ratios, and the rest. Decades of regulatory frameworks ensure this data is consistent and comparable across the traditional investment market. But crypto operates on a different infrastructure. The analysis methods do exist for this infrastructure, and they can get very sophisticated, but they are scattered across specialized crypto analysis platforms that traditional Wall Street analysts have not yet learned how to use. On-chain analysis is crypto's equivalent of corporate financial statements, but it is actually much more comprehensive. Rather than standardized reports being filed once a quarter, on-chain you can track asset flows, user adoption, revenue generation, and competitive positioning in real time with a precision that finance conducted in separated bank accounts could never even dream of. But for crypto, there is no Bloomberg terminal that is packaging all this data and analysis together in a standardized format. Instead, this on-chain data is displayed across Dune Analytics, Token Terminal, DefiLlama and Messari, and dozens of other specialized on-chain data presentation platforms. Each platform requires different skills and different familiarity. Now, in 2024, an average of 5,300 new crypto tokens launched every single day. That is one new token every 16 seconds. So how do you analyze nearly 2 million new tokens when there is no comprehensive analysis method? Well, traditional Wall Street analysts, they're looking for these familiar spoon-fed solutions like they're used to. And when they can't find the standardized PE ratio, they assume that the analysis isn't possible. But crypto protocols are generating millions in revenue right now. They just have their own metrics: revenue per user, total value locked, token velocity, liquidity rewards, to name a few. The metrics do exist, they're just not packaged the way Wall Street expects. And this actually creates a skills mismatch. It's like taking a New York real estate investment skill set and then applying that to buying Amazon manufacturing businesses in China. Both of those are investment markets, both can be very profitable, but taking one skill to the other market is likely to fail. Traditional analysts spend their careers mastering established TradFi tools and traditional financial frameworks. They become experts in reading 10K filings, interpreting GAAP accounting standards, and comparing companies with regulated industries. But crypto protocols don't file 10Ks. They don't use GAAP standards, and they're completely unregulated services. This is why crypto analysis requires specialization and, honestly, entrepreneurial thinking. The analytical methods for on-chain assets exist, but they are being crafted now in real time by this new class of on-chain investor. Consider analyzing a simple lending protocol like Compound. It's a software system that operates as a lending market. It earns revenue, it operates without a traditional management structure, and it distributes profits to token holders. Analyzing Compound properly means tracking its TVL, which is total value locked. It means tracking its TVL minus the value of its native asset comp from that TVL. It means tracking its TVL minus the influence of liquidity farmers on that protocol. It means measuring the borrowing demand across its different networks that it services. It means understanding how the interest rate changes affects user behavior. And it means comparing Compound's capital efficiency against the other competing lending protocols. Each of these metrics exists and provides insight for the crypto investor looking for returns, but there is no single platform that is aggregating all of these metrics, nor providing an analysis of them into a single opinion. And you have to compare that dynamic to what you see in the traditional financial markets. When you're buying a stock, it's been vetted by the SEC. There are quarterly earning reports behind that stock that are standardized, audited, and have been filed publicly for years. In crypto, anyone can create a token in 10 minutes with no oversight, no requirements, no accountability. There is no SEC for crypto. And so analysis of this infrastructure has required entrepreneurs to build their own tools and their own frameworks for on-chain investing. Wall Street analysts are accustomed to having established research infrastructure provided for them. And when that infrastructure doesn't exist, they're not adapting to create new methods themselves. The Bloomberg terminals traditional financial analysts use, they are the same terminals that were introduced in 1982. They are now over 40 years old. But crypto natives who are investing on-chain to make money and make returns from their investing, they are creating the new analysis tools and the new analysis methods because they had to. And really, the deeper issue here is that crypto has created new business models that traditional frameworks do not respect yet. On-chain protocols are not your typical technology company relying on a bank account, Amazon Web Services, and a website to acquire and service customers. On-chain protocols are a new way to coordinate economically to build and deliver digital services. To take a very simple, established protocol like Sky, formerly MakerDAO, as an example, it helps to understand that Sky is a platform that provides on-chain markets with a stablecoin that is censorship resistant. Now that is compared to a stablecoin like USDC or USDT, which is not censorship resistant. Sky generates revenue when a user creates Sky, the stablecoin, from their protocol, and Sky, the protocol, also generates revenue from the assets that are locked into its platform that are used as collateral to back that censorship-resistant stablecoin. Sky now manages over $16 billion worth of collateral. And traditional analysts don't have frameworks for evaluating entities like Sky because this unregulated protocol providing a censorship-resistant service, well, that dynamic has not existed in regulated, censored markets before. This is exactly why crypto investing is all in or all out. You need to have a full, deep view of the whole censorship-resistant market that is being built, or you're not going to get the market when trying to determine whether this service has product market fit yet. Now, there are analysis methods for entities like Sky, and they are sophisticated and they are data-driven. Crypto-native teams like mine have created these methods over just the last 2 to 3 years. You're tracking collateralization ratios, stability fee optimization, the governance participation rate, the competitive positioning of the protocol against the other protocols, in this case against other stablecoin issuers, and then looking at the integration with the broader on-chain ecosystem. But these metrics that go into this analysis, they're not fitting into traditional market analysis because the on-chain market itself is new. This is why crypto requires specialist knowledge, not because the analysis is less rigorous, but because it is analyzing a fundamentally new type of economic entity using methods that traditional analysts just haven't learned yet. Now, Wall Street firms are starting to get this, and they're starting to close this gap. That's why institutions like BlackRock and Fidelity have established dedicated crypto research teams. They realize that trying to get their equity teams to catch up on crypto is a losing battle. Better to go with crypto native guys in-house. But crypto native guys, the real crypto natives, they're not waiting for Wall Street to catch up, and they don't want to go work with Wall Street. Wall Street is still figuring out basic custody, regulatory compliance, how to integrate Coinbase with their bank accounts, with their 100-year-old infrastructure. Real crypto natives are building sophisticated analysis methods combined with non-custodial strategy services that capture the opportunities traditional finance investors are just missing right now. Most people lack the time and expertise to conduct this research themselves, let alone decide what implication that research has on them as an investor. That's why crypto native consultants exist. Specialists who live and breathe this market understand the technology, the on-chain data, and how to strategically position ourselves on-chain. proper portfolio allocation, institutional grade security, tax strategy, and most importantly, the systems that combine those things together. This is all part of the job of an on-chain crypto native specialist. The tools exist and the data is more comprehensive than in traditional markets, but interpreting and taking actions based on that data requires specialized skills that most traditional investors just do not have yet. They have not developed it yet. So if you want to position yourself ahead of the traditional institutions that are now playing catch up, you yourself need to master crypto native analysis or work with specialists who already have.